title of this video is Learning and Knowing When to Step Away from the Charts, which can save you from a lot of unnecessary losses and unnecessary FOMO. So if you have watched my live stream on the 21st of February, Friday, you would have known that we were looking for the 930 highs on NQ. Okay, price did not allow me a trade entry before tagging the highs right here, which was my daily objective. Alright, so because price has tagged this level, I am not trying to go long to take out these highs right here. There are several reasons for it. Number one, it's not within my rule because I don't buy above the daily open and the midnight open. Second thing, once the daily buyer's objective has been met, you do not try to go in and chase the price, because if you chase the price, something like this is going to happen to you. Very highly likely it's going to happen to you. Okay, so over here you can see that as we are trading higher, Dow Jones is trading lower. Look at the crosshair. Dow Jones was trading lower. ES is trading higher, but the strength is not present. Look at how NQ was taking out these highs up here, but ES was way below. Okay, and ES was trading into a inversion fair value gap right here. So if you zoom into the 15 minutes, you will be able to see the inversion fair value gap that was utilized to send the price higher. Right, so what can you see from this level here? I mean, from this session right now, there is a crack in correlation between the three indices. Dow Jones was trading lower aggressively, while NQ was trading higher aggressively. ES was pretty much flat. So because there is a crack in correlation, that adds on to the confluence that you should not chase the price, because one of them is going to be a false move. Right? Doesn't mean that two are moving in the same direction. The one that's moving in the other direction is a false move. Any one of them can be in a false move. So right here, it turns out that NQ and ES was the false move, and eventually they succumbed to Dow Jones trading lower. Now I mentioned this, and I mentioned why I was expecting Dow Jones to trade lower, and that could be very problematic for NQ and ES, because if you look at the current dealing range from this low to this high, we have not offered discount. For the past few weeks, we have been just ranging for Dow Jones as we traded higher for ES and for NQ. Therefore, it is very, very risky to keep on chasing longs above the weekly opening price. As well as, if you don't have the rule of buying below daily open, you're going to put yourself at such a risk whereby eventually Dow Jones is going to trade down into discount to offer discount. That is how price works. It trades from premium to discount, discount to premium. If we take a look at the weekly time frame, we have a fair value gap on the weekly time frame for Dow Jones right below the 50%. So it is totally reasonable for price to want to offer that fair value gap a rebalance in order to go higher. Therefore, we should expect NQ and ES to have a retracement similar to Dow Jones as it trades lower. That is expected because they should move in sync. With this intermarket relationship, you will be able to highlight and you will be able to see and predict the risk moving ahead into the future, which is what I did during the live stream. I mentioned this several times in this week. So because of that, going into any trading session itself, having the rule of buying below the daily open and the midnight open can help a lot, because if you're buying the lows and your invalidation point is invalidated, the losses that you take is not going to be very big. So for example, on the hourly chart, typical ICT traders would have seen this as a stop hunt and then this as a fair value gap. Okay, price traded higher, and then we formed a new fair value gap right here with a swing low. Right, so within this fair value gap, many ICT traders would have been thinking these equal highs are next, and we're going to attack these highs without understanding the context of time. So this is where time comes in play. This particular day is Friday. We attacked the highs during the AM session at 7 a.m. or to be more precise, at 8 a.m. If we were to trade up here, we should at least expect these highs right here to be taken during London to allow time for distribution to play out into these highs right here. And the fact that we only attacked this high during the distribution phase, which is the New York AM session, it is very I would say it is not the best thing to anticipate price to trade up here, because the amount of time left for Friday is very low. And if Friday is to form the high of the week, we should see more energetic price run as compared to this one on NQ and this one on ES. Make sense? The other thing is, so moving on to the point, basic ICT traders would like to look for long in this fair value gap with the invalidation down here. They're going to use the opening range, not the opening range, the dealing range, to look for discount, and then dropping down into the 1 minute, 5 minutes, 4 minutes, 2 minutes, 3 minutes, 2 minutes, right? 1 minute. Okay, so even the 1 minute, let's just say a short-term low should not be taken out right here, and it's way below discount. So let's just say we do the dealing range right here to minimize the risk. Below 50% is right at these levels right here. Okay, so look at how the price reacted off the fair value gap. It did not allow a chance to exit. The retracement was back inside this fair value gap right here, which acted as inversion to continue to send the price lower. Now obviously we have news at 9:45, which is right here. After taking out London's low, news at 9:45 traded higher and into the old low that made the high. And imagine you were to continue shorting the move after 9:45. It would have been easy in this case, but when you take a look at the amount of retracements that you have to endure, it is not the smoothest, because you are not shorting above the daily opening price. Such a move can drain your mental capital, and it can force a manual stop out on your own part. Adding on to the fact that it's Friday, it is very hard to recover, because you have to wait for at least 3 trading days if you are disciplined enough, Saturday, Sunday and Monday, in order to trade only on Tuesday. So you have to wait for 3 days with this loss right here, but knowing that your direction is correct. So naturally, when you ask a trader, would you rather participate in such a move, or would you rather participate in such a move right here, whereby you have a stop hunt and then a fair value gap and price just drops without any retracements? So this is the move that you would like to seek to find and to be in, not moves like this when they have retracements And look at the amount of range. Look at the range here, 63 points for 1 minute candles. I don't think any traders trading the how would I say, the E-mini contract would be very comfortable in this trade unless you have a very big capital, but it is a 1 minute candle. So imagine fluctuating 1002 for one contract in one single 1 minute candle. That is huge. Alright, so that is also why I always emphasize that once the objective is met, I don't do anything, because if I start to analyze as the price is falling, I would be very biased on my analysis, which is not something that I want to put trust in, because the best analysis often comes when you're calm, when you're neutral, and when you have close to no emotions. You're just reading a chart, seeing how it presents, and seeing what it is printing, instead of feeling a little bit of FOMO that you missed the move here and you want to get in, and then you're half-assing your bias, because right now you think that it's going to attack the lows right here for NQ, and then eventually maybe it's just going to leave the low and then trade up higher, giving you a very strong retracement that you didn't anticipate. Those are the things that are going to lead to small or maybe big losses if you tilt on the Friday, and the next week you're pretty much going to blow your account, because the weight that you have to carry through the 3 days will impact your next week's trading, definitely. And yeah, for this video, just a psychological, more like a supplement, so that you understand that you only trade when you plan for it. You only take trades that you plan for it. You don't take trades on the go. You don't just market in. You don't look at the price, what the price is doing now, and then you react to it. That's not how it is. You should have a framework set in place, and you should have a setup that was pre-planned. Because if you have a setup that's pre-planned, first of all, you'll be able to hold on to the position. Second thing, you will not be moving your stop losses too tight as price moves in your direction. You're not going to jam it to break even as soon as it brings you to a 1 hour, for example, or a profit monetary, in terms of monetary value, for example. You won't have the urge to do that, because you understand that you need to allow price you need to allow some breathing room for price to move. And if you keep jamming your stops and it comes back, stops you out, and then go higher in your direction, that is going to create a lot of frustration, and then you're not going to trust yourself in terms of trade management, even when you do it correctly, right? So with this, I hope you enjoyed this short little review for Friday, and it is also something for myself, because I find that I did a great job at stepping away from the markets after the objective has been met, even though I wasn't part of the run towards the objective. Alright, and that's it. Thanks for watching. If you find this insightful or helpful, do leave a like, and I'll talk to you again.